Hello, let's talk about some basic trading. Just basic trading, bare minimum trading, just enough to make you some money. Okay? So basically, we're going to chalk off this level right here is the open swing high. This level is the open swing low. Okay? These are determined by the way the market hooks. Notice the market opens, then it stops abruptly and it hooks back down. Okay? So where it made that high in the morning, that's the open swing high. Okay, now it hooks down and then it hooks back up. Where it made that low in the morning, that's the open swing low. Now if it does this over and over, okay, it just means that it's going lower than the open swing low, or it's going higher than the open swing high. It's a little bit of a different shape every morning, but the same principle applies. It's where it hooks back down first, leaving a swing high, and then where it hooks back up first, leaving an open swing low. Okay, so basically in here, what you're doing is you're looking for trade to go on up. Now, right here, you've got a resistance level. Basic concept is 2, maybe 3 ticks above the resistance line, you put in a trigger. Okay. Go ahead, if it triggers, let it go 5. Now, I better not say 5 ticks because it's not always the same. So, $50, $70, roughly every time. Okay, if the market moves fast enough, and it gives you triple digits per contract. I'm talking about per contract. Okay, then go ahead and stab the exit order and get out as fast as you can. I'm talking about take a knife and stab quickly. All right, and capture that money. Now, I've found that a lot of times, if I've had a couple of good trades, okay, where I've had triple digits, it tends to become harder to accept $50 a contract. Or maybe sometimes it's $20 to $30, which is better than losing money. And a lot of times I get that $20 or $30 when I should just accept that. Okay. But then it takes it back because I don't accept it, and then it becomes a loss. Okay, and then and then I allow it to get to perhaps triple-digit losses, or $50, $70, depending on how good I was doing before that. Okay, now this is all pretty foolish. Okay, the loss should not be more than $50. Okay. The profit should be about $50 or $70, and then close. If the market can move fast enough, take triple digits. If the market moves up and then moves against you, and then it moves positive again, just take it. Now let me repeat that. Okay, you've got to remember this. If the market moves up and then it moves against you, right? So it moves up, it triggers your order. In this case, it's a bullish order. Now, this works vice versa if you're short selling the market. Okay, so if the market moves up and then moves against you and then moves back in your favor again, even though you were looking for $50 or $70 or more, okay, just take whatever it just gave you quickly. Because what you're trying to do is not lose the trade. That's it. That's all you're trying to do. Just keep the red numbers out of your trading day. That's it. Remember this concept. If you can just stop the losing, that's it. That's all you got to think about is stop the losing. Then the money will automatically flow into your account. So, of all the things that you need to specialize in this business, it is stopping the losing, right? Never lose money, never lose money, and see the first two rules. Okay. So, what happens here? Well, the order here gets triggered in and then it falls out. Right? Basically, this is a loser. Okay. Now remember this saying: stick to a tick. Okay. A lot of times, what happens is it falls back on the other side, and then it comes right back past the same line. Okay. What I tend to do is I will give it 2 to 3 shots at trying to break out of that resistance line. And all of these rules apply to the support line. Okay, so it's just vice versa in the other direction. Okay, so I give it 2 to 3 tries to break out, and then after that I will move the line up basically to the next bar. I will make a basically what is a quasi resistance line. This is the resistance line, but I'm going to draw another line. Okay, and here's the thing: this particular trade triggers in right here, and then it switches over to this bar, and then it goes against the market. Okay, and then it comes back up. Now the thing is, I'm already stopped out, right? But it comes back up and it triggers me in again. Okay, well, good for me. And then it rises quickly enough that I can get triple digits, okay, per contract. All right. Oh, by the way, if you're a 3 contract account trader, don't trade all 3 contracts at a time. In fact, never trade even 2 contracts at a time unless you're very close to the stop. And there's only certain occasions that you ever do the double contract trade. Okay. So here's the thing. Yeah, basically with that double contract, or basically you would divide your account into 3 parts. But with that double contract situation, you basically just never add to a losing trade. It's basically the main idea. Okay. So then the market pops back up and it puts in the money there, right? Okay, so now what happens is the market runs up, falls back down. This becomes resistance right here. Yes, indeed. Well, you know what? I'll tell you what. This is not accurate. Okay, because this is what happened. The market turned over here, and then it continued up. Okay, so that doesn't make this the resistance. What it did was it continued up, and then it fell down. So it makes this the resistance. So then you're going to repeat the same thing here again. This time, the market pops over. It pulls the trade in. So now you're in the trade, and then it falls below, and it knocks you out. You're out of the trade. Okay. Yeah, those are the breaks. Now, the thing is, though, is what you got to pay attention to is you've got a lot of quick wicks here. Quick wicks are where the price has gone up and then ran back down very quickly. Okay, so the thing is, though, is that when that happens on this side, not quick tails, that's the other side. When that happens, basically it means that there are a lot of sellers right there, and there just aren't enough buyers to overpower them. Okay, so basically, this is your first clue. When it got up to here, it fell right back down. It wasn't a slow. Didn't go up there and then turn into another bar. Okay, and then start to go down, and then you'd have a solid bar up and a solid bar down, right? Now this is these are 5-minute bars, okay? 5-minute candles. No, instead it went up and then it went back down quickly. That's what that means, okay? That's a signal. That's a signal basically to everybody that's watching this. Okay. And it happened numerous times. So basically what these are drawing here, these quick wicks are drawing here, are a top, right? The sellers are up here. So there's no use in buying because there's so many sellers here and there's just not enough buyers interested that that this market's going to go any higher, okay? Although after the first time here, it tried, came back down, tested lower, and there were buyers. These two right here are quick tails. So what that means is that when price got down to here, buyers hit those prices. They were fully expecting to go through here. Now this is the entire story that happened right here. This is the story. Okay, came up to here, sellers hit right here. Not enough buyers there. But when price got back down to here, there was enough buyers to push all the way up here. Okay, and then once it got back up here again, there weren't as many buyers. There was too many sellers. And a lot of this, what it has to do with is that when basically it was trying to get over this resistance line, the stops weren't there. Basically because bears were not worried about losing money. So you got to have them worried about losing money so that they buy to cover, or they buy to get out of their short trades, and then they'll buy long too, okay? And then everybody else is buying too. So there's a whole bunch of buying here, and it goes up to the next level. And the bulls keep on making money in this case. Okay? But there wasn't enough stop there. There wasn't enough stops there. I'm sorry. I need more sleep or something. There weren't enough stops there, and so therefore you didn't get that short squeeze reaction. That's what that is. It's a short squeeze reaction. And therefore it failed. So you have all these quick wicks that are signs that it's too heavy here and there's not enough bull pressure here. Now, this is kind of a clue, and this is all kind of a clue that maybe later on in the day the price can meander higher. And in fact, that's what happens in the second half of the day. Okay, but I don't tend to wait the entire day for all that because it's a lot of waiting and staring. I tend to make the money in the riot session. I call it the riot session in the morning, and then I get out. Also notice that the volume drastically falls off here, and it's basically down to almost afternoon levels. And you know why? Because it's Friday. So this is a Friday chart, and the riot session in the morning doesn't last as long because a lot of traders, they just make a little bit in the morning, then they go, or they don't even trade. They give themselves 3-day weekends. Okay, so now this is a clue. This is looking like basically it's a bearish trade. So what you expect is for the thing to make basically a lower high. That's what this is. Okay, so it'll fall down, it'll test lower, then it'll come back up, and that'll fail. Alright, so now you want to make basically that low right there. Now let's not get these mixed up. This right here, where the price came back up, went down first, came back up, this is the lower high. Why? Because this high, this peak right here, is lower than this peak. Okay. This low right here is where it got to before it turned back up into that high right there. That high is a lower high than this high, the previous high. Okay. So that's all of the nomenclature about that. What does it mean? Basically what it means is that we already assumed that all of this was failing right here. Like this area, basically. We'll draw that up for you. Okay. This area is basically off limits. Okay. Pretty simple, right? And what does it mean? It just means that basically when it gets to here, there's a lot of sellers. Okay, so there's no acceptance of higher prices. In order to get them to accept higher prices, okay, by buying the higher prices here, they would then be looking to sell these orders or get out of these trades at even higher prices, right? That's the basic concept. Okay. Or sometimes you get pseudo, what I would call pseudo marketability or pseudo trading, okay, where you get a short squeeze which turns into basically a lot of short sellers trying to buy to cover in order to stop losing. Okay, when bulls know that, even bears, when they know that, basically they're gonna buy to cover. They're gonna buy long. Okay, and everybody just buys long, and it's just a quick trade. It doesn't mean that it's long-term investing. Long-term investors may or may not be looking for higher prices. Okay, so on a short squeeze, it always comes back down very quickly because it was basically fake market pricing. It wasn't true price discovery. Okay. Okay. And that's kind of what we're trying to look for every time. We're looking for that a little bit every time that we break out. Every time. Even if it's going the other way, it's going south. And it's breaking through the support levels. Okay. We're relying on long traders to get out of their position, hit sell, and then push the order down. Okay. That's what we're relying on. And basically, when that happens, people go ahead and sell short on top of that. Okay, and that's why it moves. Okay, every single time. It's all about starting off with basically what is a trap trade. Basically, bulls are trapped. Okay, they got to get out. They sell. Therefore, it sells off, and then everybody knows it's selling off, so they get back on there. And remember, these algorithms, they sense the volume. They know what kind of volume is it, what kind of volume it is. They sense it, they get on it, they push it down, okay? Because they're trying to front run all that volume. And the same is true on the bullish side, okay? They sense all that, and they push it up. Okay, so now we've established that this is probably a no-go zone at about this time, okay? So because we try here, we can't get the short squeeze and all the other buying because basically the stop orders aren't there. Okay, if the stop orders aren't there, it basically means that bears are not afraid. They will hang tight. They will stay short. Okay, now one attempt, maybe it doesn't mean so much, but this is 1, 2, 3, and you can almost call that one. Okay. And what about these wicks here, right? So you know this is kind of some. This is kind of one, okay? But definitely these two where it's poking out over the resistance, okay? You basically can see that bears are not scared. If they were scared, they would buy to cover, but they hold on. They don't care. And not only that, there's just not enough bulls there to go against whatever they're thinking, right? If the bulls say, well, we don't even care what the bears think, we're going to buy this. We got to get all these orders in. We got to buy all this. Well, then the bulls are really strong and they're going higher. And you know what? You know why there's no bears? Because they're going to wait until the bulls are done. They're not going to short sell down here if they see a lot of bullishness, right? But those bulls were not there. And the bears were not afraid. Okay? So that's two things that you've got to know about what's going on here. And I got to say this. When you read these charts, you got to realize that there's people underneath here. This is all a decision process. This is a crowd, okay? And there's different parts of the crowd. There's institutional, there's private wealthy, there's small private traders, okay? There's wealthy private traders. Okay. They've got different purposes. Some of them are just working for the financial part of something, and they're just hedging. That's all. There's mutual funds, right? They don't even think about really anything. All they're doing is dumping orders in routinely. Okay, so there's different reasons. There's even different nations. Okay, and it just varies. It's just a market world. It's a gigantic crowd of a lot of different interests and purposes and wealth levels and expertise and knowledge levels. Okay. There's algos and there's real traders, okay? And it's not that the algos are fake, okay? Some of the real traders use algos kind of like hitting the buy or the sell button. They use it like that, and then they turn it off. Pretty easy. Other institutions, they have a myriad of algos, and they don't really switch anything on or off. Right? It just all works automatically for them. So know what's underneath there, and you consider those algos like that. Basically, think of them like people, because what they're doing is they're actually doing what the people would decide to do. So there's still intentions. Okay, you got to understand that this is still the spirit of a crowd, whether it's algo or not. Now, sometimes you can tell the difference, but that's not very important in this video. Okay, so now we get this lower high here, and we've got this new low. Okay, that means that this is the new low, right? This is probably a reversal. Now, how do I know when the market's reversing? I look down here. I see that there was a big peak on the MACD histogram. Okay. And then it's about an hour into the market or more. And then the MACD histogram starts falling off fairly quickly or very quickly. Okay. And then the MACD histogram flips to the other side. Now, the same can happen if this was a bearish morning and then it flips up to the bullish side here, or the green histogram, right? But on this day, it was bullish and then it flips over to bearish. Now, the histogram is basically a representation of, well, it's a MACD histogram, by the way, but it's a representation of basically the delta ratio of the volume, meaning how many buyers to sellers. Okay, within the past about I don't even remember how many bars, but within the past probably about 14 or 20 bars. Okay. So basically it averages out all those bars, and then it compares them, and then it starts to basically, when it adds them up, it can determine algorithmically whether or not bull orders are becoming less or more in ratio to bear orders or sell orders, buy orders to sell orders, okay? And therefore, You can see how fast it's fallen off, how fast the ratio is changing, and therefore you know that that it's becoming something else. Now, if it's not falling off very fast, then maybe it's not a big deal. That's not very interesting. Okay. So the thing is, though, is that if the thing is flipping over here and you see a double top like this, double top means that it's about to reverse. You've got a lot of quick wicks here, and it's about that time that it could be reversing. I mean, this is only, let's see here, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 1 hour right there. So about an hour and a half. Okay, and now you flipped on the histogram and everything. Okay. Then you get this higher low right here. Right here is your new trade. Okay, you're going to short right here. Okay, don't be looking higher. It's not going higher. We proved that. So what do? You put the trigger order just on the other side of resistance. That's where this low is. Okay, a couple ticks on the other side. Okay, and then you grab 50 or 70. What happens here? Viola, you get one. You get a trade right there. Okay, so we had one bad trade, okay, and then we had one good trade, okay. Then we had one bad trade up here where it tried to get out, and then we had another bad trade, okay. So it's about even, right? About even, okay. But if you're doing this exact same thing on other markets at the same time, for instance, the gold, GC, the oil, CL, the 6E, Euro, okay, those are the other big liquid markets. The S&P 500 E-mini, if you're a beginner level, I don't recommend it. I think you need, in my opinion, you need more contracts to trade that now. It's just the way that it's trading now. I think because of the algorithms and everything in there, it's just a very algorithmically driven market. Okay, and if you're too small in there, it's really hard to make money. The ticks are pretty big, and then the fake outs are very common in there, and the price moves are often very very tiny and just not enough. It's a really twisted market these days. Stick to the NASDAQ and the gold and the oil and the 6E Euro. The moves are much more drastic. They're much more convenient or cooperative, and the ticks are smaller, so $5, $6, $10. Okay, so between the tick size and the actual volatility or the actual moves and the cooperation of the moves, I would say that on average that you're just going to make more money in them than you will the S&P 500. Although I keep the S&P 500 E-mini open so I can compare it to the NASDAQ. So I kind of basically try to arbitrage trade one-sidedly on the NASDAQ via looking at the S&P 500 E-mini for confirmation a lot of times. It helps. It helps quite a bit. Okay, so but the thing is though is that the main concept here is open swing high, open swing low, okay, and then support and resistance. Okay, you're looking for the breakout, and the reversal. Now here's the thing. Here's a couple of things that you got to know about on this one. First of all, this is Friday. Okay, so on Friday the volume dies out pretty quickly. Now the thing is you need a lot of volume to continue to move higher or to reverse and move lower a couple of legs, right? Now by a leg I mean like, okay, this right here is one leg. From support to resistance. If it breaks out of resistance and it moves up again, okay, that's another leg. And then if it moves through resistance again, that's another leg. Okay. The most common move like that is between 2 and 3 legs. Okay. This was an uncommon move right here. 1 leg, and then it quit. Why? Because first of all, North Korea. Second of all, it's Friday. Investors and traders don't want to trade and leave a lot of money on the table over the weekend. Okay? They were raising cash. That's what this was about. That's why this party ended right here, because they were raising cash, not investing cash. Okay? So basically, very dull Friday, and Fridays are actually usually dull. Sometimes they're not, but most of the time, basically, the volume's going to die out fairly early. Okay, and then it's just not as good of a trading day. Now, I don't know about you. Unless you need tons and tons of money, why stick around for more and more? I mean, the job pays enough that you can come in here for an hour to 2 hours in the mornings and then check out with more than you would be making as a doctor. Or a lawyer. Okay. And if you're going to continue to trade all day, the hard part about it is that it's really slow. You've got to wait longer for trades to come through. You definitely have to keep your eye on, four different markets at the same time on multiple monitors. Okay. And then you've got to be very conservative about your trades. Okay. And a lot of times it seems like the more that you trade, the more fake outs can possibly happen during that time after the riot session in the morning, and then you wind up giving everything back that you made that morning, and maybe even then some. Okay, and then some days, if you trade all day, then it's still good. You're still making. But if you average out, for me, when I average out the rest of the day after day, basically I break even. Or maybe I do okay, but it's not worth it to me to sit all that time when I need this money to go on and do other things. I've got projects, I've got to research, I've got other things going on besides. This is basically just the money side of my business, okay? And then I've got other business I've got to go do now that I've got the money. The reason why I do this is because I need a bunch of money in a short amount of time. Where else can I do that besides here, right? So, I mean, between minimal time and maximum money, my problem's solved in the morning. I'm not going to waste a bunch of time trading before the open or after the riot session because it just doesn't average out quite right. So I'll just take the sweet spot and move on and do the rest of my business, right, outside of this. Okay. And most traders feel that way. They just feel that way. That's just how it is in the industry. Yes, you will have floor traders in pits. They're not as common as they used to be. They will hang out all day, and they will continue to trade. They'll trade for their clients. They'll work orders for their clients or that kind of thing. There's prop firms that may or may not stick around all day. There's no mandatory rule that they've got to stick around all day. And then there's hedge funds, right? Institutional traders where they have floors of traders at desks on computers. They'll stick around all day and they will work their orders, right? They're given so much money every day. They got to have that amount of money into whatever they're putting in, and they're there all day, whether it's stocks or anything else, or futures or whatever. But for the most part, the bulk of all of these people drop off a ton in the morning, and then the rest of us trade the riot session and make a ton, and then we just leave it to everybody else, and that's why it acts the way it acts. Okay. And so on a Friday, it's almost the weekend. There's North Korean problems as well. So all these things put together, we come up with a very dull Friday. So what does that mean? That means that I can show you one leg, and I can show you a couple of head fakes here, and I can show you that I would be breaking even on this particular day before I get out. Okay. Now, why did I stick around long enough to see this? See, this is 8:30 right here. Okay. Because I knew this was a double top. I could see this was reversing. I could see the histogram was flipping over. And therefore, I knew this was going to be basically what we call a cup and handle. The cup and handle is basically, this is the cup, the bottom of the cup. It's an upside down cup. This is the handle. Okay. Now, the top of that cup is right here. Okay. Right there where that low was. Okay. And basically what it means is that once it breaks through there, there's a trap there. Basically, longs are stuck. Okay. We know there's longs right here. We can see that they were fighting to keep price up here. Bears had them going, right? Pushed them down here, and then they fought to get it back up there. Same thing here. Pushed them down here, fought to get it back up. Pushed them down again, even a little bit lower, a couple ticks lower. Then fought to get it back up there again. Okay. So we know there's longs in here. They're long right there. Now, if we can push them south of resistance right here, they will sell. And if they sell, that'll push the price low enough that you can get a full trade out of that. Okay. And therefore, that's the trade that would break you even. And then basically it's just boredom for the rest of the day. You know what happens when you're bored? You overtrade. You see patterns that aren't really patterns. It drives me nuts. Okay. So that's about where I would get out. It was a bad Friday, that's all. Right? I didn't make any. But do you know how much I make every other day? It's... Look, and I'm talking about 3 contract accounts. Okay. So, once you get up to 15 contract accounts at your firm, and then you make an account big enough that you can get out of the firm, okay, and fund yourself privately, okay. It's phenomenal what you can make in a week. This day like this is not a problem. I just showed up to see if there was anything there. There wasn't anything there. Okay, I'm fine. I'm set. Not mad. I'm not eager either. Okay. I mean, I want to work, but I'm not I'm not desperate. See, part of the problem with trading is that you might get desperate. So if I'm sitting here breaking even, I might want to continue trading. Should I? No. This is a really bad Friday. Shouldn't. Now, if you want to practice, by all means, continue to practice. In fact, if you haven't traded full days before, I recommend trading a lot of them. I traded probably about 2 years of full days on the S&P 500 and off and on other markets, mostly the S&P 500 E-mini. Okay. So I basically understand the crowd and the times and what the signals are on here. Okay, I know the language, right? I'm a native. Speak the language natively. Okay, but it took me a while to get that far. All right, so that's breakouts. Okay. Maybe 50 to 70 bucks on the losing side, 50 to 70 bucks on the winning side. If price is moving fast enough, take more. Okay, so if you were like, okay, well, 50, is it 50, 70, boom, geez, 120, 150, or maybe 200 or 300. Sometimes that happens, and it happens in a snap. Okay, just stab it and grab it. Don't sit around and wait, right? It's that kind of situation where the car drives around the street, 4-door car drives around the street, they got tinted windows, one of them rolls down, out comes a briefcase, Some jerk looks out. He's got sunglasses on, dark sunglasses, yells something you can't even hear. Briefcase smacks you in the chest, falls on the ground, cracks open. There's money all over the place. Car squeals around the corner. They're yelling and honking or shooting or something. Okay, those are crooks probably. Why don't we just take their money and put it to something good, right? We'll go to church or whatever, but, don't sit there and wait for more. Okay? Only an idiot would sit there and wait for more. You've got plenty right there. Okay, grab that, go into a store right next to you, walk out the back, go across the street, walk through another one, walk through another block. Same thing, and just cross town like that. Get out of there with that money. That's the same thing here. You're looking for you're working for $50, $70 a trade, okay? Per contract, I'm talking about per contract. And then the market pops a briefcase right on you, right? Stab the close button and get out. That's it, okay? And sometimes it's hard. Now, the thing is, you'll goof up, okay? I'm promising you right now that basically after you get a couple of those, you'll start to get greedy. And so when you're supposed to be looking just for $50, okay, then basically you're going to wind up waiting for $100 or more or whatever when you shouldn't be doing that. Okay, you're taking too long in the trade, really. That's really what it's about. You're taking too long in the trade, and then what happens? Price comes back. They come back around the corner. Here comes the cart. And then what are you doing with our money? And they just snatch. Okay. And then you're left all broken up in the account. You got, you're laid up. You got debt all over you. It's a murder scene, okay? And you're in it. That's your account. What did you do? You took too long in the trade. That's what you did. Well, you'll learn, okay? You'll learn. This is the street, buddy. This is Wall Street, okay? You gotta trade tough. Gotta be quick on the draw. In and out. Stay about. Okay. You don't need every dollar in this thing. If you're looking for every dollar in this thing, you're gonna lose every dollar. That's just a fact. Okay. Sometimes the market looks so good and you're looking back and you're thinking, wow, if I was doing what this guy was telling me, Tootin' Knight was telling me, then I would have all that money. Why am I doing what he's doing? I could have all that money because the market fell off or something, right? You've got a big gap down or a big gap up, and you're just salivating, wishing that you held on all those bars. No. Those happen once in a while, and when you get stuck in those, and then they fly back on you, because what happens? The damn thing. You see, more times than not on those things, when you're trying to get those, more time than not, that car comes back. Price comes back in a car, right? Squealing tires, yelling out the window, out the door they come in. They're just beaten down. Your account's brutalized. Now, who are you answering to? First of all, if you're doing this privately, you don't tell anybody. Why? Because if you tell people that you're losing your ass on this job, what are the people going to say? Right? Are you a loser? You're one of those gambling idiots. Right? You're a fool. Okay? What are you going to tell the people online, right? At the trading forums, the chat rooms and stuff like that? You don't tell them. You got to act cool, man. This is the street. It's Wall Street. Hang tough with the traders. Yeah, I know. I've been there. So have they. They've all been there. Okay? And so I'm telling you from experience, okay, that you just get these little pops through the resistance and through the support, okay, and just go with about 2 to 3 legs at the turnaround. So here's the turnaround. Here's the breakout. This is going to be a bullish day. It's above the open swing high right here. Okay. There's one leg. Now this was an awkward Friday. You should know in the news that there's some kind of war stuff going on. Okay. You should also know that the market's rolling over, right? Had a big sell-off this week. Okay. So keep an eye on the day chart. See what's happening before. Keep an eye on the big headlines. See if there's anything big. Even if it's political. Okay. Economic reports, that kind of thing. You got to kind of keep an eye on the score out there. So you can understand when this happens, why it's happening. Then you can understand, yeah, this is definitely a reversal. Okay. This could have gone 2 or 3 legs or 4 or 5 or whatever. Maybe. But it's just going to go one leg and then reverse. Okay. But yeah, basically the rule of thumb is 2 or 3 legs and then get out. Even if it's going to leg on up and leg on up. If you're looking for that 4th and 5th leg, sometimes even if you're looking for the 3rd one, okay, half of the time you're going to lose the trade. The other half of the time you're going to make the trade. So which would you rather have? More risk or less risk? So I'm telling you, 2 or 3 legs and then let that chart go until it reverses. How do you know it reverses? Cup and handle. MACD histogram flips right at the cup and handle, right? Sometimes you get a double top or double bottom, but you always get that lower high before it goes lower, or that higher low before it goes higher. And don't trade reversals any other way. And then just grab 1 or 2 trades after that because it's already into the middle part of the day. Okay. The 2 or 3 leg rule is for the open part of the day, the morning part of the day. After it's gone up or it's gone down, it reverses because traders have made their money, they're going home. Okay. So automatically there's not enough market participation to keep the market moving and rolling. They're going home. So the market automatically reverses. Also, institutions see those lower prices or their higher prices. Okay. Everybody else has got their fills, right? So now it's their turn. They got higher prices, okay, they'll sell. Or they'll short. They got lower prices, okay, they'll buy. Or they'll buy to cover or whatever. Okay. And then give it, probably 1 or 2 legs. 1 or 2 legs. Now that means that 2 iffy. Definitely 1. Okay. And then that chart is shot. That chart is shot. Basically, you've got to just do that. Okay. Put it on the back burner. Okay. Look for the same things in the other charts. And then about, I don't know what time zone you're in, but about an hour and a half, start looking for excuses to get out. Now, if you think that this thing is about to set up, maybe stay another half hour or another hour. Okay. But about an hour and a half after the U.S. equities open, that's NYSE stock market, after it opens, about an hour and a half after that, no matter what market you're in, folks are heading home. Okay. Before that, between the open and that time, that's when the most traders are in these markets, okay, including stocks, the oil, the gold, the 6E euro, right? The equities futures, the bonds, even the bonds. Then they're out, okay? So, look for it in another chart, okay? See if you can get a couple of legs. Right? See if it's going to give you a reversal. If not, get out. Because all you're going to do is going to wind up getting bored, over trading, wasting your time, exposing yourself to more risk, and then wind up beating yourself on the head. So that basically is just everything in a nutshell. Okay? That is enough information right there to pass anyone through the combine. If you opened up today and you started trading today, okay, I guarantee you in 6 months you would have a funded account and you would be in the 5 figures profit area, okay? Guarantee you. Now, a lot of the problem is that you're interested in a lot of other things in these markets, okay? You're interested in a lot of other kind of trades and strategies and indicators and news data and more time. You want to put more time into it? Okay, if you're putting more time into it, just know that you're practicing. Practice hard. Wreck those trades. Wreck them hard, okay? Don't just trade with 3 when you practice. Try out 100 contracts. Or if you're trying to trade stocks the same way, try out $100,000 trade, okay? Go big, wreck hard, look at the losses, go, oh, wow. Look at the profits and just, right? Get it all in you, you know? Kind of like a dog in the dirt rolling around trying to dust himself, okay? Get it all on you, or a chipmunk or a bird or whatever, okay? Because that's how you're going to learn. You got to know what the limitations are. Okay? You got to know what does it take to really do it really bad. What does it take to basically just totally blow it out the top. Right? Get everything in you. But basically, when it comes down to it, the serious time for the small time investor is just limited to that riot session in the morning for an hour and a half to about 2.5 hours after the equities open, maybe a little longer, maybe. If the thing is still setting up into a reversal, then yeah, okay? And just limit those orders, okay? 50, 70 bucks losses, 50, 70 buck wins. Put the stops on there. Make sure that you got a stop loss on there. If you don't put a target, a profit target order, so that way you limit yourself to 50 bucks or 75 bucks. It's different ticks per market, right? Because the NASDAQ is 5 bucks per tick. The 6E Euro is about 6 1/4, I think, per tick. The oil is $10 per tick. The gold is $10 per tick. So adjust the number of ticks that you're looking for, right? So in the case of the NASDAQ, if you're just looking for 50 bucks, okay, put your profit target at 10 ticks, okay? If you're looking for 70, that's 20 bucks more, okay? So that's 4 ticks more. No. Yeah, 4 ticks more, so 14 ticks, okay? And then figure it out for the other markets. It's fairly simple. I'm falling asleep, so I'm not going to do some math really fast. But use your stops. And I'll tell you why. Because if you're trading multiple markets especially, now if you're focusing on one market, you'll be quicker. But a lot of times what I've noticed is that things can be moving so slowly that basically I kind of get cumbersome, okay? And my reflexes become unreliable sometimes. And so what'll happen is the market will shoot back at me, and then I'll be down triple digits, 200, 300 per contract. And I'm going, oh, well, there went my day. Why? Because I didn't use stops, okay? So there's that problem. So use stops. Another thing that happens, it goes the other way sometimes. Sometimes the market moves, it'll move through the sky, and then by the time I look back at it, it's already back down to where it started, and then maybe it's going lower, or it already came back halfway or whatever, and I'm going, oh, why didn't I see that? I could have saw that and made so much money. Right? So sometimes it really pays to put a profit target on there. And if you put that on there, it's the surest way. Now here's the thing. As far as a stop order, it's going to work every time. Okay? And then if the trade doesn't go right, put the trigger back above that same place, because a lot of times it dips down and then it goes back up. Before it really breaks out, it tests lower again and then it breaks out. Same way when it's breaking out to the downside, it tests higher again and then it breaks out again, and then that's the real trade. Okay, so basically stick to a tick, meaning that just put the same trade on. Again, if it breaks through, great. If not, forget about it. Or maybe even just look for another chart because it's acting goofy. If the market's acting goofy, maybe just don't do business with it. Remember that. That's an option. Okay? Be real serious and strict with the rules. That'll work too. Now on the other hand, sometimes you can put a $50 profit target, right? So that way when the price gets up there, you got $50 profit, it hits the limit order, it gets you out. You've got $50 profit. But here's the problem. Sometimes it doesn't do that. Sometimes it goes up $40 worth or $30 worth, okay? And in those cases, you're kind of wishing that you would have taken that, okay? So it depends on how long you're in the trade, okay? And these trades are just really, they're seconds, really. Sometimes they're minutes, okay? But most of the times they're just seconds. So if it hasn't even reached $50, it's not just going to give it to you real fast. Forget about it. Forget about it. Just take the 40 or 30 or whatever. And if the price dips down and it doesn't stop you out, but it comes back up and it gives you like 20 or 30 or maybe even 10, okay? And it's taken too long. And I'm talking about seconds. I'm not talking about minutes. I'm saying, hey, as fast as you can ask a question and you can figure out if that person has got it or that person doesn't, whether that person answers you or not. If it's taken too long to get the right answer, close the trade, okay? Get out of it with 20 or 30 bucks or 10 bucks, okay? Because if it's already gone bad and then it came back up, it's not going good. More times than not. That's what the problem is. That's what the deal is. That's your deal. This is your business. If half of the times the trade that went south and then came back up and then went higher won and you got the good trade, and half of the times the trade went south on you, went bad on you, came back, and then you got a little bit of it before it went south on you completely and then you blew out the trade. Okay, if it was half and half like that, then basically if you wait for the trade to always go good and half of them go bad and half of them go good, how much do you make? To be honest with you, as long as the stop loss is less than the profit target, okay, as in the profitable trades are greater than the losing trades, you profit a little, in fact. Okay. If this is happening more, right, they go south, come back, give you a little bit of a teaser, and then it goes wrong again. Okay. If it happens more often like that than it goes bad, and then it goes good, and then it goes good, and you get a good trade, okay? Then automatically you're wasting your time if you're waiting for these things, okay? So learn to time the thing. As fast as you can ask the question and figure out if this person is holding out on you, is not going to tell you, basically is not going to give it up to you, okay, is as long as you need to learn in the trade at those breakouts whether or not this is going to be a good trade or not. Now you can mess around all you want, okay, but I'm saying that this is a business. If you want consistent profits and consistently not losing any money, right? Always cut off the losses. If you cut off the losses, if you just do that one thing, cut off the losses, the money's going to come to you. I mean, it's going to fall in your lap. You're going to pass the combine, all the tests that the firm puts on you to get a funded account with them. Okay? It's going to fall in your lap because that's the only thing that can happen. If the only thing you need to know in this thing is how to not lose money. That's it. As soon as you can do that, the offense is clear in the blue. You can do whatever you want because it's just going to come to you. Right? And these investors, they know that. That's why you can go to like the big dogs and ask for more money if they've seen your reputation and seen your record, right? Show them your IRS thing or whatever. Go to a bank. Okay? Those kind of things, right? You know, go to the right places where they offer people like you. What they're going to know is that what they know about all investors, you know how to stop the losses. If you know how to stop the losses, then you can't lose their money. Right? And I mean, if it was like an anomaly or something, maybe you'll break even with their money. Okay. But for the most part, you're going to profit on it. And then you're going to come back for more again, right? You're going to pay them back, and then you'll come back for more, and they'll give you a better deal. Every time you come back with their money and the profit, right, they get a cut. They're going to give you more, and they're going to charge you less. Okay? They want a piece of that. The only thing that they're interested in is your ability to not lose money. Okay? So you have to look at these things statistically. Statistically look at these things. Okay? How often does this trade come up? This particular kind of trade comes up all the time. How often does it go bad and then go good and then become a winning trade? Not as many times as it goes bad, comes back a little bit, doesn't give you your full 50 or 70, and then goes south again, and then it's a losing trade. So what do you need to do? When it comes back, even if you've got to break even, but if it gives you 10, 15, 20, 30 bucks, take it. It's good enough. As long as you don't get a red trade. That's it. That's all you want. Even if it breaks even, it's still good. It's still good. You're still pro. That's the mark of a pro. You don't lose. Okay? And that's the first block. Okay? To your office building. Okay? That one thing. That's enough right there. Okay? To basically pour your foundation to your office building. Okay? And then like a row of bricks around the perimeter. Okay? So this will get you that far. Just these pop-outs. Cut the losing trades. Control the losses. Make sure that your winning trades average more than your losing trades. That's how. 2 or 3 legs in the morning in the riot sessions. Okay, on the liquid markets, only liquid markets. And the reason why you only trade the riot sessions is because there's so much participation. Okay, that it's really hard for anybody to think differently and push the market the other way. That's why it's the most profitable time. Because if everybody's pushing at the same time, pushing for more money, it's hard to push against them and actually control the market. Okay? But when there's not as much participation, there's less volume, there's less liquidity, it doesn't take as many to control the price of the market. And they know when you're making money, and they're just going to hit that price, and then you're losing money all of a sudden. So the market says one thing, they see it, they make it do the exact opposite. So it's just bizarro world. And nothing makes sense. But when there's everybody here in the mornings, then everybody drives by the rules for the most part. Now you can see some behaviors are kind of awkward here. Look at the day of the week. Look at the news. Okay? Figure out how all that stuff works. I'll probably add a video about that stuff. That's probably a good topic. Now, here's the thing. 2 or 3 legs in that morning, whether it's going up or down, look for the reversal, and then 1 or 2 legs, and then that market's shot. Okay? Keep your MACD on, look for that reversal. If it's reversing, you're getting a cup and handle or whatever, you got long wicks or long tails down here at the bottom, right? Because it's a bullish reversal. Okay? And your MACD's flipping over. Those are all the signs. Another sign is basically you've got a short price bar and a really long volume bar. Now there wasn't one here on this day, but this was kind of a dull, sleepy Friday. Okay, but most of the time there's a big, long volume bar right at the bottom or the very top of that pivot. Okay, and sometimes the bearish reversal will sometimes it's not going to have a really big volume bar, but the bullish reversal virtually every time, just a dead giveaway, it's got this really long volume bar. It sticks out like a sore thumb. Okay, it's the sign. Then what you're doing is you're waiting for it to go back up a little, test lower, and then start to go back up, and then where it's going to break out there at resistance, that's where you start getting in. Okay, wait, don't get greedy, because the thing can continue to go down. Wait for it to actually break out. I've made the mistake many times. Okay, because I anticipate, I get greedy. I'm like, okay, well, I've seen this a million times. I'll get in early. I'll make even more. Yeah, it rarely works out. It'll work out sometimes. Most of the time, it doesn't. And then where am I at? I'm averaging a deficit. So why even bother? Get as much risk out of my portfolio, out of my account as possible, right? Just stick to the winners. Okay? Plug up the leaks, and you're set. You'll fill up the lake. Viola, your own lake. Lake Capital. You capitalists. Okay? So, there's the lesson, and good luck.